In part 2, we will see what types of short-term financial policy may be implemented by the firm. There are two different types of short-term financial policy. First way is the flexible financial policy. As shown in graph, a firm expects maximum amount of cash it needs and hold as a form of cash and marketable securities. So the firm must have large amount of cash, marketable securities, receivables, and inventories. It is possible for the firm who has relatively low level of short-term liabilities, since it is always ready. In emergency, cash is always available and shortage costs are low. But the firm should hold large amount of liquid assets which generate lower returns. Opportunity costs may exist. If long-term debts are used to finance short-term assets, it is a risky decision because of mismatching. The next one is restrictive financial policy. As shown in the figure, a firm expects the minimum cash it needs and hold cash and marketable securities up to this level. If it needs more cash, the firm uses short-term financing. So the firm tends to hold lower level of cash, marketable securities, receivables, and inventories. These type of firms generally hold high level of short-term liabilities and their liquidities are low. The benefits are the firm can get higher return on holding long-term assets and carrying costs are low since inventory level is low. Short-term liability can be decreased more easily in case of economic downturn. However, in an emergency, the firm may face liquidity problems more easily and the shortage costs are high. Which one is good for us? We need to consider several factors. If we hold high level of inventories, carrying costs occur, including opportunity costs of having current assets versus investing in long-term assets. However, if we hold low level of inventories, shortage costs may occur. We need to order additional inventories more often, generating order costs. If inventories are out of stocks, we may lose customers and sales, generating stock out cost. So when you hold current assets, we need to determine the level of the permanent current assets, which is the level of current asset the company retains regardless of any seasonality in sales. Then we may add temporary current assets when we need them. To choose the best policy, we need to consider cash reserve, matching maturities, and interest rates. Many firms do not exclusively choose one of the two policies we saw. They compromise. They hold current asset between the maximum level and minimum needs and use short-term financing if they need. They also maintain certain level of cash reserve for emergency. So a firm plans short-term financing using cash budget. It identifies when short-term financing may be required. The procedure is first identifying sales and cash collection and then find various cash outflows. We subtract outflow from inflows and find investing and financing needs. Let's see an example. We have the following scenario. Expected sale by quarter is 200, 300, 250, and 400 million. Beginning receivable is 120 million, and we can collect beginning receivable plus half of current sales. Payable is 60% of sales, and wage, taxes, and other expenses are 20% of sales. interest and dividend are 20 million per quarter. And in quarter 2, we plan to use $100 million for major expansion. Beginning cash balance is $20 million, and we always maintain at least $10 million cash. Let's compute cash collection and disbursement for each quarter. In quarter 1, beginning balance of receivable is 120. Sales are 200. We collect beginning receivable, 120, plus half of current sales, 100, total 220. And ending receivable is 120 plus 200 minus 220, 100 million. Same way, in quarter 2, beginning 100, sales 300, collecting is 100 beginning, and 150 half of sales, 250. So ending is 150. In quarter 3 and 4, we can use same way to compute each cash collection and receivables as shown in table. Then what about disbursement? In quarter 1, payable is 60% of sales, 200, $120 million. Expenses are 20%, 20% times 200, 40 million, and interest and dividends are 20 million. So total cash disbursement is 120 plus 40 plus 20 equals to $180 million. Same way, quarter 2, 3, 4, we need to disperse 360, 220, 340 million each quarter. Note that in quarter 2, we have one-time capital expenditure. Using collection and disbursement level, we can find cash balance. In quarter 1, 220 collection and 180 disbursement. So net cash flow is 40 million, positive. Our given beginning cash balance is $20 million. Adding net cash flow, 40 million. Ending cash balance is $60 million. Since we must maintain at least 10 million cash, our cumulative cash surplus is ending balance minus minimum cash reserve, $50 million. In quarter 2, collect is 250 and disbursement is 360. So net cash flow is negative 110 million. With that, beginning balance, cash balance is 60 and ending is 60 minus 110. Net cash flow, negative 50 million. Since we must have 10 million cash, we have cash deficit $60 million. We use the AMA to get cumulative cash surplus or deficit in quarter 3 and 4, and 5 million and 20 million cash deficits in each quarter. Finally, how much short-term financing is needed? First quarter, we have 50 million surplus, so no financing is needed. From second quarter, we have deficit. We need to finance $60 million. Then in the third quarter, starting with the beginning cash, 10 million. Net cash flow is 55, and we need to pay interest on short-term financing. If the APR is 20%, each quarter interest on short-term debt is 5% of the short-term borrowings. This case, 60 million times 0.05, 3 million. Then we can pay back $52 million to the short-term debt principal. So our new short-term borrowing balance is $8 million. Fourth quarter again, $10 million beginning minimum cash balance. Net cash flow is negative $15 million. Now we need to finance more, including this $50 million net cash flow plus the interest on loan balance, 5% of $8,400,000. So we need to borrow $15.4 million. Our ending short-term debt level is $8 million plus $15.4 million, $23.4 million. This is how to build a short-term financing planning. Before finishing the chapter, please solve second pop quiz. Thank you.